Great. Well, welcome to Main Street Markets, Jack. Super excited to have you, and can't wait to hear your perspective on your own investment journey.
Sure. So I can give you my journey. It's not super exciting because I started off quite boring of everything was just index funds. Everything was S&P 500. And then at some point in 2020, I read something that said instead of buying the S&P 500, why not you could buy the top 7 stocks or so and it would perform similarly, but your gains would be more extreme, your losses would be more extreme. And I thought that was a really cool idea. And I'm going to come back to this because this is part of what I am trying now. But that was my first real exposure to replication and that I can
Application.
mimic payoff. So that was the beginning. And then in December 2020, I was on Wall Street Bets and I started seeing these posts about GameStop. And I threw some money in. I bought a few shares, not many by any means, and I doubled my value really quickly. And that was exciting. Got out, bought options with that, did
Uh,
very well. And it was a little bit of beginner's luck if I'm honest, but it was exciting nonetheless. Um And then ever since then, it's just been a journey going forward. When they turned off the buy button in January 2021, that turned me more from a I'm going to pick stocks and stuff to now I want to research and I want to understand the mechanics of the market and I want to understand as many aspects of the market as possible. So I shifted into the mechanics of the market. I've shifted into voting rights and taxes, and then lately hedging options and replication. So that's where I'm at.
wow, quite the journey from long-term index investing to getting into the nitty-gritty of the market. That's really interesting, Jack.
There
Before
was
we
no concept of selling. That was never an idea I ever had. It was I'm gonna buy something, I'm gonna hold it, and I'm holding it forever.
Really, where's that mentality come from? Is that something you learned when you were starting to research index funds very early on? What's the story there? It's a great
Well,
long-term perspective.
it was it was really just simply the S&P 500 over the long run is gonna grow historically. Understood the power of compound interest,
Hmm.
and it was literally just that. And it was the belief that I'm not as smart as the people on Wall Street. So let me just throw my stuff into the S&P 500 and call it a day.
Mm. And was that something that you understood the power of compounding, the power of a diversified basket of stocks fairly early on in your career, and you always sort of saw investing as the path to growing it sounds like long-term wealth?
Yes. Um, I'm a math guy. Compound interest was I understood that in middle school. Um, so it was really just I'm just gonna throw money at this, and in the long run, it will work out. And that's still my philosophy for most of my money, but now I'm playing with a portion of my money in what I deem as, we'll call it riskier, but in reality, it's just a type of diversification. It's a type of risk. It's a type of hedging that's really going on now. So I'm making up a number. 80% of my invested money is in the S&P 500. 20% I'm playing with in riskier, more speculative things. Make sense?
Yeah, so what's your approach with that? Do you view it I mean, how much time are you putting into it? How much effort and focus do you put towards it? What's that look like on your end, Jack?
Oh man. Um, if we're talking just like how do I decide a stock to pick, it's I've gone through phases. So first phase was I'm just going to pick stuff that I think sounds like it's going to work out. So at first I put some money into pot stocks. That didn't work. Um, then um, I started following the trends of Reddit. That worked for a bit because I was just, going with the momentum, but I was getting out quickly, and that was the key to me. It was, I want to get quick wins and call it a day. That was the big philosophical change I've had, is if I can get in and get out quickly, that's different than a long-term investing strategy.
Mm.
However, or not however, this has all shifted over the past 3 years of my research, because when the whole GameStop thing started, it was short selling is bad. Short selling is abusive. There's a lot of problems with it. And there are a myriad of problems with short selling. But I said to myself, I have to do it if I want to learn it. I have to do it. I have to figure out the nuances of how it works. I have to see where the abuse can be, if there's even abuse. So I started looking into, how can I short? What's a good strategy? So I just started buying tons of books. So I've implemented small, long short portfolios, where most of it is long, but a small portion of it is short, just in case. And I want to see what happens. Then I started dabbling with, what if I did naked shorting, maybe had something to hedge against it just in case, like a call option way, way out of the money. So I started doing that. And shorting in general has not produced significant gains, but it hasn't produced really any losses. So to me, this has just been a learning experience. This is just, I have to spend money to learn how the mechanics of shorting truly works. So that was one strategy. Second strategy that I've gone down is, I've said, I just need to learn to program. I need to learn to code. I need to learn how to get data from brokers, Yahoo Finance, what have you. So started attempting to build, we'll call them stock screeners. We'll
Oh.
call them maybe arbitrage opportunities. Um, and then I haven't technically implemented this. It's still in like testing phase. I'm trying to implement a live trading bot that's gonna just run 24/7 in crypto, um, just to kind of see what happens. See if I get it right. See if what can I learn? Because I'll definitely learn something. And this, just for the sake of this is entirely algorithmic trading. So it's purely technical indicators.
Mm. Wow, that's quite a transition. Was it easier to get the data in crypto, or what was the difference between doing an algorithm on that versus what you saw with Yahoo Finance and the broker data?
Only reason I chose crypto is for taxes. So um and this comes back to the areas of focus that I've studied over the time. One heavily being taxes. I discovered crypto doesn't have a concept of wash sales.
Mm.
I am not classified as a trader, therefore I have to be cognizant of wash sales. So if I were to trade regular stocks like Apple and be in and out, and maybe losing today but gaining tomorrow, that would be a wash sale. So crypto was the solution, or what I thought was the solution. Just to recap, the bot is going with a tax like slant. That's kind of the driving force.
Tax slant?
Does that make sense? It's all about wash sales, or avoiding wash sales.
Really, what was the inspiration behind learning coding and putting that all together, Jack?
Um, it more started with, I wanted a screener just to help identify things. So one of them was, one of the first screeners I did was around put call parity, which I'll just explain it for people if they don't know what this is. But put call parity is a method of pricing options, one, but two, it it feeds into the concept of no arbitrage. Effectively, there is a relationship between stock, call, puts, and bonds, where mathematically, and this is like the biggest thing ever, you can create two portfolios that have the exact same economic payoff, but constructed with different instruments. Um, Saying this slightly differently, if one portfolio is more expensive than the other, you can short one or go long the other. That's where the arbitrage comes in. So that was really the first one. It was, I'm going to build an arbitrage screener. It identified arbitrage opportunities. But then what I learned later is um, it may see the opportunities, but it doesn't mean the opportunity is really there for me to trade.
Really? It might not be
As
there
in
for
as
you?
in the broker or the liquidity is not necessarily there, or maybe it's
Mhm.
there, but it disappears very quickly because this one that I created was a screener, so I still had to react after the fact,
Mm,
manually. And we're not talking like massive profits. We're talking like $5 here and there kind of thing.
mhm. Is that because it was hard? Were you able to send orders to your broker through the screener, through the algorithm, or was that ever part of
Uh,
your mission plan?
it was part of the plan. I never turned it on. I always wanted to see it first. I always had the belief that if I'm entering these really complex positions, because essentially what I'm going to be doing is I'm going to be going long some stuff, I'm going to be going short some stuff. What if what if I'm wrong? That was always my fear. What if I'm wrong and I enter a really like naked position and something goes wrong? So that's why I always did it manually. Um, However, this WebSocket thing that I'm working on that's going to be trading in real time, that will be truly long and short and truly naked to some extent.
Can you talk to us a little more about what you mean by naked? And it's really interesting to hear about the development that's gone into building out this tool for trading.
Yeah, so naked essentially means I do not have the underlying. So you could, I'm making this up. You could sell a call on GameStop, and if you don't have 100 shares, it's naked at that moment. Um, I am only wanting to do it just to see what it's like. I don't really want to be naked too much. I just want to, as I said, I need to do things in order to learn them. There's only so much I can get from reading a paper or watching a video. And I am completely fine losing some money along the way as just the educational cost. It's the cost of education is how I see it.
Yeah, it's market tuition right there.
Yeah, yeah. And I don't expect to necessarily win boatloads of money, but as long as I have good risk management, I'm happy.
It sounds like it's been quite the journey from going into the S&P index fund to now developing your own trading algorithms.
Yeah, it's complete. It's night and day, and it's crazy because there's that, but then there's also I am so in the weeds of market mechanics and nuances of like rules and laws. It's nuts. The markets are, I think, possibly the most fascinating thing I've ever seen.
Really. What makes you say that, Jack?
I just think there's so much. It's so simple, yet at the same time, it's a function of math, and then it gets insanely complex. We're talking you have PhDs from the 70s, 80s who were gonna go work on rockets, who all of a sudden went to Wall Street, and just all of their math over the years building and getting better and understanding, how markets work or pricing like volatility. It's amazing.
And are these sort of the tools that you've built your algorithms on top of, this technical price action base?
Um, so I would say so I'm using standard technical indicators. So we're talking um, RSI, Bollinger Bands, um, various types of moving averages. Really nothing super mathy. Um, However, the option stuff is where the super math stuff comes along. And I find that just intellectually stimulating. I think it's amazing to just see the math that's really going on at some of these levels. I don't necessarily understand it all the time, but it's not necessarily a deterrent. I just gotta find something more basic before I can go back to it. And that's a lot of what my journey has been. It's I pick something way too advanced to start. I then have to break it down into something more simple and manageable, and then we go from there.
Wow, incredible. And having looked at the nuances and the details of all these market mechanisms, what do you have to say from the perspective of the everyday investors? Are like, where's the opportunity for them? Are there these different paths to go down? How did you end up going down these development and exploration paths? Was it just trying to beat the market? Was it trying to increase your returns, or was it always getting rid of risk? What's the story there, Jack?
It was it was heavily about just learning as much as I can so that I could know more and make a better informed decision. If the end result after all of my analysis is putting my money in the S&P 500 is just the way to go, I'm happy if that's my conclusion. Like that's fine. Um it was I just wanted something honestly when the buy button got turned off with in January, it just lit something under me and I just had to learn as much as I possibly could in as many different areas as I possibly could. And the the one that we're focusing on at the moment is I had to do trading in ways that I've never done before. It's the only way I can learn it. There's not many books on short selling.
What have been
And
the
then
biggest
you
things?
sorry, go ahead.
What have been the biggest things you've seen if you've learned that going down that journey related to the infrastructure side of things?
Um One of the cool I'm gonna say cool, but I don't know if it's really cool, is the idea that there are other ways to short is just fascinating to me, or there's other ways to go long. So for instance, I could um I could buy a put. I think GameStop's trading at say $13 right now. I could buy a put at $14 right now, that expires this afternoon, and assuming it stays under $14, come Monday, I will have effectively shorted it. That's a really interesting thing that I've never seen truly spelled out that there are other ways to short. I didn't necessarily go to the market and say, I want to short this right off the bat. I'm just doing it via this option. Just to add, not all brokers will allow you to do that. It won't necessarily actually result in shorting, but it was learning just there are various weird things that go on. Um, I will tell you though, the first thing that really set off, hey, there's a lot of nuances and words matter, was this thing called the bankruptcy jackpot. So after the buy button got turned off in January 2021, we the I'm saying we, but Reddit had various communities dedicated to GameStop. And eventually the most popular one at the moment is Super Stunk. But eventually this woman by the name of Dr. Suzanne Trimbath, I'm assuming you know who she is, but she did an interview with someone on the in the community talking about her book. And one of the things that came up in this conversation was this thing called the bankruptcy jackpot. And what it alleged was you could short a company to bankruptcy, never close your position, and as a result, never pay taxes. So kind of a double win if you think about it. And that was something I didn't 100% believe because it's the IRS. You pay taxes, done. And I went down this path of finding documents, seeing the mechanics of how could I actually not pay taxes? And I talked to my broker, I asked them various questions, and the conclusion I made is you have to pay taxes, but you might be able to get away with it in this one scenario. But technically, you have to pay taxes. And that original, it was really the second document that helped me with this conclusion, has been the one document I keep going back to over and over and over. And it has a plethora of information in it. And that's where all my research about short selling, voting, it all stems from this one. It's a government document. It's a congressional committee document. It's just fascinating. And that research then just led to tons and tons of other sources.
Really? So you saw this interview and it led you to this one congressional document. And then tell us a little more. What were the big challenges that you saw on the voting and the other market mechanic parts of
Mm.
it?
So just to clarify, no one ever pointed me to the document. It
Mm,
was more they gave this interview, they said this exists, and I said, "Nah, you got to pay taxes. How could this possibly be true?" And the first thing I really looked up was how does bankruptcy work, and that's what the document started with. Um, I'm sorry. What was your
And so you
question there?
found a way where was it big institutions that were doing this, or were there everyday traders that were doing this
So
bankruptcy drug?
I don't know if anyone actually. So let me clarify. I don't know if anyone actually does this. I don't know if it really is doable. I just think it might be maybe doable because the way it works is, and this is only based on my broker TD Ameritrade because I asked them. So normally, if you go long and you close your position, you get a 1099B, I think it is. And on that, it talks about your gains and blah blah blah, and that's also passed the IRS. What I discovered was if you short a company and it never goes to zero, one, you've technically not closed your position. By definition, you have not closed your position. And that is a very interesting concept, I think. Two, according to my broker, they don't actually pass that information along to the IRS. However, the IRS is very clear on how to treat worthless securities. And it says when it is worthless, treat it as zero. They even go into a specific scenario about how to do it when you're shorting. But they're clear. You were supposed to realize the gain. So that's why I'm saying the IRS is clear. You pay taxes. However, according to my broker, they're never informing the IRS about that. So
Really?
that is where the potential opportunity for abuse lies. But again, I have no idea if it truly is happening. And Dr. T, Suzanne Trimbath, and I can't come up with his last name, but West, the attorney from Texas, also has alleged that this happens. But again, I don't think anyone has actually proven it.
Wow, it sounds like you've diving really deep into the market infrastructure side of things. Let's
Oh,
maybe
I
yeah,
know
go
what your
ahead.
question was. It was about voting rights, right? Yeah,
Yeah, it's an interesting point.
sure. So you asked how does this all then eventually translate to voting rights abuse?
Mm,
Simplistically, uh, the end result is shorting. Let, actually, let's back up for a second. For simplicity of argument, there's two kinds of shares or types of ownership. You can either be a record holder or a beneficial owner. A record holder is the legal owner of the actual share. A beneficial owner is not the legal owner of shares. Beneficial owner is trading what is known as security entitlements. So if you have shares with Fidelity, you're not really the record holder, you're a beneficial owner. And this is borderline a quote from this document I mentioned a few minutes ago. But a direct result of shorting is it increases the total beneficial number of shares. What that means is there's more security entitlements than there are shares. So that's the first statement. And if you want to say it more generically, it's in effect there are more shares than there should be.
Mm.
So we have this situation where there's more security entitlements than there should be. And now we go to voting. Voting is such a black box and not regulated, I think, well, that weird things can happen. And the weird things that can happen are overvoting. So let's say a company issued 100 shares, there should only be 100 votes. However, the net result is 150 votes come back. So the question is, how do they reduce that 150 to 100? Someone has to get screwed over in that normalization. And that was an incredible moment for me. And then everything has a lot of what I do goes right back to that as an idea. There's this incredible paper or article by Bob Drummond, and I'm gonna butcher this stat, but it's something like in a particular year they looked at 300-ish votes, like corporate votes, and in 100% of the cases there was overvoting.
100% of the cases. How's that possible?
That's the problem. That's exactly the problem. And the reason this happens is they essentially don't know who should vote at the end of the day. So what the brokers are doing is they're sending out all their votes. You end up with 150 people voting when only 100 should have. And that's how you end up with this overvoting.
And that's because of the short sellers?
It is. It is. I'm going to see if I can pull up this quote. See if I can find it. Oh, okay. So I said 314. The actual number was 341. So in 341 shareholder votes in 2005, it found evidence of overvoting, the submission of too many ballots in all 341 cases.
Wow.
And a quote from this by the way, this study was done by the it's called the Hazlitt, which is a New Jersey-based security transfer association. The chief executive of, I think, them said a lot of the time we have no idea who's entitled to vote and who isn't. It's nothing short of criminal. So because they have no idea about this, it leads to this overvoting.
Wow. Do you think, Jack, that's a problem with the regulatory clarity? Do you think it's a problem with the market infrastructure or something with the brokers? How do you look at that?
Man, that's a tough one. Um, so it goes back to, is shorting a problem or not? And in the beginning, I thought shorting was bad. I think my real answer is abusive shorting is bad.
Hmm.
And that's where the problem is. It's FTDs related. There's so many things that are interconnected here, but it's FTDs related. So it's a market structure, it's a rule enforcement, and I also think the tabulator is a black box that's a bit unregulated because when in the example I just gave you where I said 150 votes are returned, let's pretend that's 150 votes going to Fidelity, and they really only are supposed to have 100 votes. How Fidelity reduces that 150 to 100 is completely up to them. What they do can be different than TD Ameritrade, can be different than Charles Schwab, and so on. So there's no uniformity there. Um, the key message to drive home is one share, one vote is not honored. And that's the fundamental problem with short selling. It clearly shows that can't can't happen. And I think that is why it's the simplest message to show short selling can be abusive.
Wow. So you've really found this problem with how the shares are recorded that manifests in these corporate governance challenges and is a symptom of a it sounds like an underlying challenge with how they reconcile these short positions that you've been experimenting with. Is that about right for listeners?
Um, I don't think I'm contributing to it. I think it's more the bigger players. I think it's the market makers who maybe have an exemption. I think me trading 100 shares is not moving the
Not what I
needle.
meant. Yeah.
Um, but yeah, market makers have an
Have
exemption.
an exemption?
Um, yeah, where they can short all day long as they say they can locate the shares, what that mean or sorry, as long as they're making a market, but that's unclear technically on what that means. Um, and short selling and this overvoting is heavily related to FTDs or failures to deliver. And I'm sure you know what that is, but if you buy 100 shares of a company and you don't get it in 2 days, that's a failure to deliver by definition, and nothing really guarantees you'll get your shares, and that's part of the
Really?
problem. So, um, I forgot who it was. I think it was Leslie Bonney in, like, 2004 did some analysis on, FTDs, and basically her conclusion was brokers do not force buy-ins because they want to get that preferential treatment when they're on the other end. Um, Personally, I think there's um, another possible reason, and this is going to be very complex to articulate, but I think due to accounting rules, FTDs, when backed by the NSCC, technically do not age. And this is a wild statement. So I'm basically saying an FTD today is one, or from yesterday is 1 day old. An FTD from 10 days ago, it's still technically 1 day old because the way they do their account, this is what I'm alleging. The way they do their accounting is they say, what's the present value of our FTDs today? That's how many FTDs we have. And that means that FTDs, if what I'm saying is correct, FTDs are always 1 day old. They're never persistent. They're never abusive. They're never a problem. And that's why the DTC can stand behind and say, FTDs are not really that big of a deal. It doesn't happen often.
Really? So the DTC can downplay, it sounds like, this challenge with the securities actually being delivered between the brokers.
That's what I am arguing. I'm basing this on there's one comment letter from I think it's an SEC commissioner talking about aged fails of treasuries. And they mention the treatment of FTDs as always 1 day old. And then interestingly enough, about 6 months ago, a year, Susan Trimbeth and another academic said something slightly different, but it's similar enough that makes me think I'm on the right track, where it's they reset the counters is kind of what she said. And the problem is going back to enforcement is the NSCC and the DTCC will say, we're not an enforcement agency. It is not our job to do this. So, despite there being rules that there should be buy ins, It's not their job to force it, to enforce that rule.
Wow. So it sounds like they're just throwing their hands up and playing victim. Is that accurate?
I don't know if I would necessarily say victim, but more it's just not our place to do this. That the enforcement power is with the SEC and Congress. And I'm stealing this summary from there was an exchange with Robert Shapiro and a lawyer of either the DTCC or the NSCC. I can't remember which one, but basically they the DTCC or the NSCC said we're not an enforcement agency. And that's how I think they get around this.
Really? And just let the problem persist with the FTDs.
And it's now up to the brokers to sort out however they will, if they will. And this is how I don't know how familiar you are with Overstock, but Overstock was on the threshold list for like 600 plus days.
Yeah.
And technically, if you're being severely shorted, you shouldn't be on that threshold list that many days. So, how is that possible? And my theory goes back to it's because the FTDs are never that old. They're not really persistent. They can just keep shorting. But that should be the perfect example that shows something's going wrong. No one's enforcing the rules because Overstock should not be on the threshold list for 600 plus days.
It's ridiculous. Having seen this underside of the market through it sounds like extensive research, what do you think happens if someone steps in and starts enforcing these rules?
And that's a tough question.
Especially
I
on the
think
source selling side you've seen.
I will say that um, I know FTDs have been flagged as an issue since the late 80s by a former SEC commissioner,
Really?
Pollock, who, whatever year he retired, there's this report called the Pollock Report. And he says something like substantial buildup of FTDs is a problem. I think though it even goes back further, like into the 60s and 70s, where they've known this is an issue. I think the way they handled the show, where they grandfathered the current short positions, says that they can't fully fix things right away. It's only a going forward kind of thing. So I don't know if there's a negative impact that comes when they start to enforce these rules because I think they're going to use some grandfathering logic, unfortunately.
Oh, so you think that they've already, the problems happened and they've built a way to protect themselves from having to fix it? Is that accurate?
Um, Not that they've built a way to protect themselves, more like I just think rules won't apply to trades that happened before today, kind of thing. And it's more going to be the SEC doing that. I don't think this is the hedge funds or the banks doing any of this. I think it's the SEC. And this is just I'm slowly basing this on Reg Show. I'm basing this that Reg Show has been amended, I think twice, and all of the real ideas in Reg Show were the original ideas back in the 80s, and they've only implemented a handful of them. So what the suggested remedies are fairly clear. They just don't go far enough with the rules or whatever's being implemented.
Really? So the SEC's known about sort of all the potential solutions since the 80s, but over time they haven't all been implemented. Is that right?
Yeah, that's very, very true. So, um, I'd have to go find, let me see if I can find it really quickly. I'd have to go find what stuff was not said or what was not implemented. Let me see. Okay. So, um, nah, I guess I can't find it fast enough.
It
I don't want
sounds
to just like give
like
you dead
a
time.
lot of thought has gone into really understanding the history of some of the market regulation and challenges on the underlying and especially on the DTC side of things.
Absolutely. Yeah. That was honestly when the buy button got turned off, that's just this all came from it. So like it's they have effectively made retail smarter. Retail is a lot more knowledgeable than they have ever been before. Retail knows more about market mechanics than I think some industry experts probably know. And retail will eventually figure something out, and I think they have, honestly. But retail will eventually figure some things out that are gonna be really problematic, that are gonna be tough to reconcile with.
Tough to reconcile with?
I think the idea that you don't own your shares is a huge statement that probably most of the people don't know. I think the concept of that and all the implications that stem from not owning your shares is what leads to all of the abuse in the market, or rather, a lot of the abuse in the market. So I think people need to be educated, and I think we have a small group of retail investors that are starting that and have been doing so for the past 2 to 3 years.
Good. Can you tell us a little more about that, Jack?
Sure. So there's various communities on Reddit. There's even a group that's focused on just DRSing, and DRS stands for Direct Registration System. And basically, this group is entirely about promoting the value of being the legal owner and the merits that come from that. And for me, it's it started with I want to be able to guarantee I have one share, one vote. All the other benefits of being a legal owner, fantastic. But that was my like North Star. But there's a group of people, ydrs.org, great advocacy group, great documents, great research that goes into talking about the value of DRS and why you want to be a legal owner.
And how does that affect your perspective with most of your portfolio still in the broader market? How does all this that you've uncovered affect your perspective for investing in stocks in general?
That's a phenomenal question. It to some extent, and so most of my money is unfortunately in a 401k. I don't have a lot of flexibility on how that can be invested because it's with an employer. So unfortunately, that's in the an S&P 500 type fund. If though I did not have that restriction, I would be DRSing the top 5 to 10 stocks of the S&P 500, and that would be my quote unquote S&P 500 index fund. Um, but you're spot on. How I am technically investing doesn't fully align to what I believe, and that's a function of my employer 401k plan.
It sounds like you believe really strongly in the benefits of DRSing the shares themselves. What do you think are the
Yeah.
long-term implications of that?
Um, I think one great implication is just the advocacy that a group of people have around promoting it. That's fantastic. If we're talking just me, I think it's one, knowing I own those shares.
Mm,
That makes me happy. Knowing I have one share, one vote guaranteed, that makes me happy. Knowing if anything goes wrong and we go bankrupt, if I've held those shares long enough, I have protections that other people who have shares in a broker do not have. It gives me more protection than just a regular brokerage account.
really, it gives you more protection than you'd
Yes,
normally have.
yes, I'll give you an example. Um, if I have a company that goes bankrupt and somehow they decide they're going to pay out shareholders, as a beneficial owner where I have shares, say with Fidelity, am out of scope for how I will be compensated. All that matters of how they will be compensated are record holders. And this is exactly what happened in a case with Dole a few years ago. And the
Really.
judge basically said the language of it's out of scope what happens with beneficial owners. They know the risks. They know what they've signed up for. Um, it also gives me what's known as the continuous holder requirement. This is not something by definition you can have as a beneficial owner. Continuous holder requirement, forget if it's 1 or 2 years, but basically, if you hold it for this duration, if something goes bad, you do have a legal claim that you can stand upon, and it holds up in Delaware courts. And this comes into when we're talking like um, appraisal rights, and I think Dell is the example of where there was some crazy appraisal right stuff, and the continuous holder requirement came up.
Really.
I think that was the one we talked about, right? Was it Dell?
And what's that mean? So you're saying that you have a benefit when you hold the stock long enough, when it's DRS and it's in your name, you'll get special benefits in Delaware courts?
You will have fulfilled the continuous holder requirement, which is something that is needed should there be um, compensation to record holders.
Gotcha.
So I forget the full details of it, but basically, a group did not fulfill this continuous holder requirement, and therefore they were not eligible to be compensated. So
Wow.
the way I think about it is DRSing is safer than keeping shares in a brokerage account.
Hmm.
It's what's the crypto line? Like my keys
Yeah, not your keys.
yeah, that's what it is. It's this.
Has that been a similar approach? So holding it in your own name with having it in your own custody, has that been your approach with the trading algorithms that you wrote for the crypto markets too?
Um Most of my so I'm not a big crypto person. Let me start with that. I know very, 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 very little. And basically like 2 or 3 years ago, I started like I opened a Coinbase wallet. I just want to see like how stuff works. So I don't have a ton of funds in crypto, but most of my funds are actually held in my own wallet. The trading algorithm will not be, unfortunately. That will be with Alpaca, which is a broker.
Really? And what's that like? What would you recommend? Did you have a background in development for individuals getting into developing their own kinds of algorithms?
I have no formal background. I just have what I've learned along the way. Um, it's a lot of trial and error, failure, starting over, that kind of thing. Um, but as long as you enjoy that process, it's fun. Um, but there are a lot of moments of absolutely no progress or absolutely going back to the start.
Really?
Um, oh yeah, many times, many times. Because it could be it could be as simple as, because again, I'm not a professional like coder. It could be as simple as, oh, I didn't think about the architecture of this, or if maybe I change this one thing, it would be a lot more powerful because it could open me up to doing a few other things I didn't think of. And I think that's kind of just the lack of experience in being like a true coder. Um, there's phenomenal videos out there. There's tons of things on YouTube that people can learn from.
And has that been your general approach to learning about investing, learning about development, and even learning about some of these challenges on the market infrastructure side of things? What's that look like from your perspective?
So coding is predominantly the internet and YouTube. But there's 1 or 2 books I've gotten along the way that I think have been really helpful. Um, in terms of investing, mostly YouTube, and just various, Reddit communities. And then in terms of call it market mechanics, history, that kind of thing, that's just pure internet and me. That is finding something, going to the footnote, that footnote leading me to something, that paper leading me to something, and so on.
Wow. It sounds like you take a very diligent approach to learning and mastering different aspects of your investing journey.
Try. I don't know if I've necessarily mastered, but I try. And I think as long as I'm learning along the way, I'm happy. And as long as maybe I'm shining a little bit more light onto some crazy small aspect of the market that no one's ever thought about, I'm happy. If one person can like take one idea I've come up with and run with it, that's amazing.
Well, on that note, what would be your best advice to someone who's just starting out? Where should they start to really understand and build their own portfolio, for instance?
Mm. If I was like say a fresh out of school kid, first thing I would do is I'd probably buy an index fund and then I'd go read and learn. And I would open up Excel and I would run simulations of what does compound interest do to $100 invested growing at say like 4, that's the different scenarios, 4%, 7%, that kind of thing. See what it looks like over 30 years. Understand that. That's the power of compound interest, and that's huge, and that's why you should invest in an index fund. In parallel, I would just start learning about companies, learning about sectors. I don't think it matters which companies you learn about. I don't think it matters what sectors you learn about. I think it's just jump into one that interests you, whatever that may be, and just learn. Um, look into how to value a stock. Look into fundamental analysis. Look into technical analysis. You might, at the end of the day, say, I don't believe in fundamental analysis or I don't believe in technical analysis. That's fine, but just learn as much as you can. And at that point, start to take some risks and pick some individual stocks and just see what can happen. Um, avoid options in the beginning would be my strong recommendation. But when you're ready to progress to what you think is the next level, start to look into covered calls, start to look into like puts. Um, that's how I would do it. And then if you're interested in coding, you gotta do all that stuff first, and in parallel, learn to code, and then you can maybe start to piece some of it together.
It sounds like a very balanced approach with everything, having that long-term side and still being able to get in and out of individual positions a little more actively.
And it goes back to the concept of that is technically diversification. It's I have safe stuff and I have riskier stuff. It's a hedge. It's I have just decided for me, I'm comfortable with this risk. And I firmly believe if you're on the younger end, take some risks, learn from it. I'm not talking like lose hundreds of thousands of dollars, but lose a few hundred and you'll learn from it. You won't learn adequately with paper trading. So that's trading with
Yeah.
fake money. You need to have real skin in the game. You need to see what it's like to lose $100 in seconds. You need that like psychological experience. Unfortunately,
You really prepared him for the best here.
I try. I don't know if I would. If I was starting over and I was going to pick an individual stock to like start with, I would probably lean towards something I knew, which would be Apple, Google, Microsoft,
Right.
something like that. That's it. Just see what happens kind of thing.
Wow. Incredible, Jack. What a journey that you've gone through of self-education and discovery. It sounds like have just been big drivers for you.
Yeah, thank you. I would say a lot of it is self-education, but I think there's also the community aspect.
Community has been
And
big.
and and that more from the market mechanics piece, the history of the markets, because someone will write a post, someone will maybe add a comment, and then that allows for conversation and dialogue to happen, and maybe some new idea or maybe some new source is shared that sparks something with someone else. Like I think that's really important for the history and the mechanics aspect.
That's interesting. So I know coming up on top of the hour, it's so interesting. So you're saying that community has been, and please by all means share whatever you're comfortable with. How has community affected the way that you look at your investments and building your portfolio?
Oh, sorry, not at my portfolio really. No, no,
Uh-huh.
I'm talking more just the
The
history or
history.
the market mechanics. So let's pretend someone writes a great post on FTDs. That
Hmm.
leads to some conversation that happens. Someone shares a citation that leads to some other paper. That's what I mean in the
That's
community.
what you mean.
There are definitely though posts on Wall Street bets where you have to learn to sift through it. But there's some intelligent posts on there where people make a case on why this is a good investment or why this is a bad investment, and then people respond accordingly. That's great to see.
Wow. It sounds like you take a very wide range, not just in your investments, but also in the information and the development that you do in your own work. That's really incredible, Jack.
Thank you. Yeah, I wanna take as much in as possible to make an informed decision. And as I said in the beginning, if my conclusion is put it all in the S&P 500, I'm happy to do that. I just need to prove it to myself. But I don't believe that, by the way.
And I don't believe that. Have you seen the ability to outperform yourself?
Rather, I don't believe all of your money should go into the S&P 500 or some
Ah,
broad-based index fund. I think a portion should be risky. I really believe that. So I see there's a minute left. Is this able to keep going or does it
yeah,
stop?
we keep going. But
I'm ca- I'm happy to keep going. Don't take that as let's keep going for this. If you want to end it, that's fine.
it's fine. Just wanted to finish on that point of risk. So, how do you see that developing from starting to finishing sort of your investing life cycle? Where does that risk play into the decisions that you make? Is it just increasing volatility, or is it having different aspects for the returns? What is your approach generally for that?
I feel like there's a few answers in here. So one is something that everyone who picks up an investing book, I'm sure, sees, but I never understood it until fairly recently, which is position size and risk management. The ability to say, I got this wrong, I'm done with this trade, is tough. At least for me, it's really tough. So that's the thing that was actually one of the key reasons I wanted a trading bot. I wanted to take out my own reasoning on why I'm going to stay in a trade for too long. I wanted something that would say, no, you've lost 20%, you're done. Um, so position size and risk management, I think, is possibly the real key to success. Um, a related risk management aspect is diversification. All of your money should not go into one single. Pick a few things. Maybe consider a long short portfolio. As long as things can start to balance somehow, you're okay.
Really insightful, Jack. Thank you so much. And where can listeners go to learn more or get more about what you're working on or information you'd recommend?
Um, I think the one place I would really strongly recommend is people check out ydrs.org. As for like stuff I'm working on, I'm on Reddit. You can find me there. It's my name is Jack Spades 123. Um, but honestly, I think just start Googling these things and just see what comes up. You'll really start to learn.
Wow, very inspiring. And anything else you'd like to leave them with to get them all started and make sure they have success with investing, Jack?
Just try. That's really it. It's okay if you lose. Just try. I guarantee you will learn something by trying. Don't invest like your life savings, but just try and you will learn. The market is clearly a way to wealth. Just gotta try and learn.
Well, thank you so much, Jack. Really inspirational.
Thank you. Thanks for your time.
Of course.